We're clearly so leveraged in equities in this country. We're so dependent upon firm equity prices at this point in time. And when I say leveraged, we're 252% of stock market cap to GDP. So 1929, we were, I think at the top we were 65%. And then in 87, we got to about 85 or 90%. In 2000, we got to 170%. And now we're at 252. So you can just imagine, if you think about the periodicity of significant bear markets, since 1970, we get kind of a mean reversion about, on average, every 10 years. When I say mean reversion, let's say mean revert to the past 25 or 30 year PE. So if we did that here, that would be, and again, these are elevated PEs, way elevated beyond the 20th century. That would be say a 30-35% decline. Well, 35% on 250% of GDP is 80-90% of GDP. The reverse wealth effect, oh my gosh. 10% of our tax revenues or capital gains, they go to zero. So you can see the budget deficit blowing up. You can see the bond market getting smoked. You can see this kind of negative self-reinforcing effect. And so it's troubling. We're clearly in a sovereign debt bubble. In the stock market, we're over-equitized as a country, have the highest individual equity weightings in the history of the country. And then the real problem is, if you look at private equity in 2007, 2008, that was about 7% of institutional portfolios. Now it's about 16% of institutional portfolios. Real estate's gone up. Infrastructure bets have gone up. We're so much more liquid than we were in 2008. So you have to be cognizant of that fact when you think about how you have your money deployed. I had a friend ask me, he said, if you were investing for 20 years, what would you tell somebody? And because he knows that I'm supposed to say, you just buy the S&P, close your eyes. Well, the problem is that if you buy the S&P at this current valuation, the 10-year forward returns negative when you buy with the S&P PE of 22. That's what history shows. So yes, the S&P is a spectacular long-term, if you have a 100-year view, but that's because that's an average of 100 years, including times when the S&P 500 PE was 6 and 7 and 8, or 1/3 of what it is right now. So valuation matters a lot, and the stock market's really high, and it's going to be really hard to make money from here.